In the early 1970s, the world was rocked by an unprecedented event that sent shockwaves through the global economy, the oil crisis of 1973–1974. This period was marked by a sharp rise in oil prices and a shortage of oil supplies, which had a significant impact on industrialized nations, particularly those heavily reliant on oil imports. The roots of the oil crisis can be traced back to a number of factors, including the growing demand for oil in the post-World War II era, the decline of U.S. oil production, and the geopolitical tensions of the Cold War. However, the crisis was ultimately triggered by the decision of Arab oil-producing countries to embargo oil exports to countries that supported Israel in the Yom Kippur War of 1973. This decision led to a rapid rise in oil prices, which increased by 70% in just a matter of months. The impact of the oil crisis was felt across the world, with many countries struggling to cope with the sudden rise in oil prices. In the United States, for example, there were long lines at gas stations, and the price of gasoline doubled within a matter of weeks. The crisis also led to a decline in economic growth and an increase in inflation, as businesses struggled to cope with rising energy costs. The oil crisis of 1973–1974 was a major global event that had a significant impact on the world economy. The crisis began in October 1973, when members of the Organization of Arab Petroleum Exporting Countries (OAPEC) imposed an oil embargo on countries that supported Israel in the Yom Kippur War. The embargo led to a significant increase in the price of oil, which had far-reaching effects on the global economy. One of the most immediate impacts of the rise in oil prices during the 1973–1974 oil crisis was inflation. The price of oil rose from $3 per barrel to $12 per barrel, leading to a sharp increase in the cost of production and transportation of goods and services. This increase in costs was passed on to consumers in the form of higher prices, leading to an increase in inflation. The inflation rate in the United States, for example, rose from 3.4% in 1972 to 12.3% in 1974, the highest rate since World War II. The increase in inflation had a significant impact on the purchasing power of consumers and businesses, reducing their ability to spend on non-oil-related goods and services. The rise in oil prices also had a significant impact on international trade balances. Countries that were net importers of oil, such as the United States, Japan, and Western Europe, were negatively affected by the rise in oil prices. This was because they had to pay more for the oil they imported, which led to a trade deficit. For example, the United States, which imported 35% of its oil in 1973, saw its trade deficit increase from $4.5 billion in 1972 to $12.4 billion in 1974. On the other hand, countries that were net exporters of oil, such as Saudi Arabia and Iran, benefited from the rise in oil prices. This was because they were able to sell their oil for a higher price, which led to a trade surplus. The rise in oil prices during the 1973–1974 oil crisis also had a significant impact on the stock market. The profitability of companies in the oil and gas sector increased, leading to higher stock prices for these companies. However, for companies in other sectors, such as manufacturing and retail, higher oil prices led to lower profits and stock prices. For example, the stock prices of automobile manufacturers, such as General Motors and Ford, fell significantly during the crisis, as higher oil prices led to a decline in demand for their products. The rise in oil prices also had a significant impact on the labor market. When the cost of production and transportation increased, companies reduced their workforce to reduce costs. For example, in the United States, the number of people employed in the automobile industry fell from 885,000 in 1972 to 742,000 in 1975, due in part to the decline in demand for automobiles caused by higher oil prices. The rise in oil prices also led to a decline in the number of jobs in the airline industry, as higher oil prices led to a decline in demand for air travel. Finally, the rise in oil prices during the 1973–1974 oil crisis had a significant impact on economic growth. The increase in the cost of production and transportation led to a decline in investment and expansion plans by companies. This, in turn, led to a decline in economic growth. For example, in the United States, the gross domestic product (GDP) growth rate fell from 5.1% in 1973 to 2.7% in 1974, due in part to the impact of the oil crisis on the economy. The rise in oil prices during the 1973–1974 oil crisis had far-reaching effects on the global economy. The increase in the price of oil led to inflation, trade deficits, declining stock prices, a reduction in employment opportunities, and a decline in economic growth. While some countries that were net exporters of oil benefited from the rise in oil prices, the negative impacts of the crisis were felt across the world. The crisis also highlighted the dependence of many countries on oil and the need for measures to reduce this dependence. The 1973–1974 oil crisis led to a significant shift in the energy policies of many countries. Countries began to invest in research and development to develop more energy-efficient technologies and to promote the use of alternative sources of energy, such as wind and solar power. The crisis also led to the formation of the International Energy Agency (IEA) in 1974, which was tasked with ensuring a reliable supply of oil to member countries and promoting energy efficiency. The oil crisis of 1973–1974 serves as a reminder of the importance of energy security and the need for policies that promote energy efficiency and reduce dependence on oil. It also highlights the need for countries to work together to ensure a reliable supply of energy and to promote sustainable economic growth. By learning from the lessons of the past, we can ensure a more stable and sustainable future for all. In conclusion, the rise in oil prices during the 1973–1974 oil crisis had a significant impact on the global economy. The increase in the price of oil led to inflation, trade deficits, declining stock prices, a reduction in employment opportunities, and a decline in economic growth. The crisis highlighted the dependence of many countries on oil and the need for measures to reduce this dependence. The crisis also led to a shift in energy policies and the formation of the International Energy Agency. The lessons learned from the crisis are still relevant today and serve as a reminder of the importance of energy security and sustainable economic growth. This is for educational purposes only and should not be taken as financial advice. The information provided is not intended to be a substitute for professional financial advice. Please consult a financial professional before making any financial decisions. Please comment, like and subscribe.